Hey everyone, welcome to a special episode of In the Money with Amber Kanwar. We're going to do things a little bit differently this episode, and honestly, the markets are just too chaotic not to do that. The S&P 500 is trading at a 14-month low. The TSX is trading at an 8-month low. The price of oil is below $60 per barrel, for goodness sake. That's like a 4-year low. And of course, we all know the reason why. It's because of tariffs. What we don't know is how long is this going to last? So I've enlisted Frances Horodelski, who many of you know, but she was my former colleague at BNN Bloomberg, and before that had a very long career on Bay Street. She's going to offer her words of wisdom and what she's looking at. And then we're going to speak to Darcy Morris of Ewing Morris. He's an activist investor. This is the kind of investing where you go into a company and you say, I want you to do this, this, and this. Sometimes they listen and the stock goes up. Sometimes they don't, and you're in for a bit of a battle. He's got a bunch of war stories to share with us. And he also talks about when you do this kind of investing, how hard is it when the whole tape is getting thrown out? I hope you'll enjoy today's show. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're a do-it-yourself investor, BMO InvestorLine Self-Directed is the perfect platform for you. With powerful tools and commission-free trading on over 100 ETFs, you'll have everything you need to take control of your investments and build a portfolio that's right for you. Learn more at bmo.com/investorline. So today's show is going to be a little bit different just because we are in the midst of sort of an unprecedented move in stocks. The S&P 500 is on the verge of a bear market, which, by the way, I think would be the fastest move from an all-time high to a bear market. At the same time, we've got bonds that are freaking out right now. These yields are moving higher. And even if you don't know much about finance, the upshot of that is interest rates are moving higher very quickly. And sometimes when that happens too quickly, there can be big problems in the market and the way the financial system operates. Of course, we know why this is happening. This is because of tariffs and a tariff war by the U.S. against pretty much every country on the planet. But in particular, there's a big escalation going on between the U.S. and China. So as it stands right now, Chinese goods going into the U.S. are tariffed at 104%. U.S. goods going into China are tariffed at 84%. I don't know what this is going to look like in the next minute, in the next hour, in the next 24 hours when this podcast airs. That's how quickly things are moving. So that's a lot for the stock market and for the bond market to adjust to. And I'll basically use any excuse, doesn't have to be a crisis, but this time it is, to bring on Frances Horodelski, my former colleague at BNN Bloomberg, now a blog writer, but she's always in the markets, whether she's on TV or not. And so she joins me now on the podcast. Frances, thanks so much for making time for us.
Great to be here, Amber. Nice to see you.
So when we were back on the desk together on air doing live TV, I feel like this is where you in particular thrived. What's your starting point? What are you looking at?
Well, I could start optimistically, but let's start where you maybe ended in that introduction, is with respect to the fixed income markets. And as I've been tweeting over the past couple of days, every time we have these kinds of dislocations in the market, I have to relearn the plumbing of the financial system. And I'm not going to go into the details of it because, quite frankly, it seems pretty arcane to me. But what is happening is, because things have moved so quickly, there's such great uncertainty that people are worried that something's going to break in the financial system. Is it going to break? I doubt it, because there's enough knowledge in that plumbing in the central banks of the world, including the Fed, including the Bank of Canada, the Bank of England, whoever it is. They're going to make sure that something doesn't break. But in the interim, we've had these dislocations. So the 10-year U.S. Treasury yield has risen the fastest in any particular time since back to 2001. So you're seeing this sharp rise in interest rates. And that is one of the components that goes into valuations of stocks, the discount rate. Let's use that. So as rates go up, stock prices go down. And then you have all of the other mess in terms of what's this going to mean to earnings. We saw this morning that Walmart pulled or is not providing a profit forecast for the next quarter because, quite frankly, they don't know, and you're probably going to see more of that. So you're uncertain on the yield, the earnings. You've got rising interest rates. They're not excessive, but they are rising, and then you have prices falling. So you've got these relationships that are unwinding, and people are trying to find out where or how far they unwind.
And so much of this, like we're just talking symptoms, right? These are all symptoms of the cause, which is trade. And so if you're an investor, you have to think about, okay, this is how it might manifest. This is what the breakdown might look like. When are we going to get the cure? And I think based on the actions in the last, like, call it 24, 48 hours by the US and China, it seems like they're only escalating, right? There's no signs, at least right now, of de-escalation, though that could come in a tweet. Like literally the markets are up at this moment, midday, because Trump said, go buy stocks, which just seems like a sort of wild reason to build a rally. But it shows like how desperate investors are to rally, right? Like any bit of good news, we know what kind of upside there is because the market has demonstrated. It'll go up 6%, it'll go up 7% in a day on any reprieve. The question is like, when do we get that reprieve? And if the US wants to break China, I don't think this gets resolved very soon.
No, that is certainly true. And I think the reason the markets rallied on that Truth Social post was that they say, oh, he's watching, he's seeing what's going on, because before he had said he wasn't. Somebody's going to have to blink. And if they don't blink, the dynamics will take longer to resolve. And so what we will see over time is a de-emphasis on trading with America and more emphasis of trading with everybody else. Everybody else is 70% of the global economy. America's 35%, depending on what day you're talking. So that's going to take longer. I think that's going to happen anyway to some extent, because the confidence in, your biggest trading partner has just been cut off at the knees. But that takes time. So in the interim, you get these crazy rallies and these crazy falls, and you get a hedge fund blowing up. So depending on who is listening to all of this, though, it sounds scary. It sounds like, I don't know what's going to happen. And so I've been talking to a lot of people about how you approach this. What do you do? Well, first off, you don't have to do anything. You don't have to be the hero to catch that bottom tick. I mean, I'd love to be able to do that, but you don't have to be that hero. You're not going to get the top. You're not going to get the bottom. Hopefully you get what's in between, as somebody smart said to me once. The second thing is you got to make sure that you are you're around long enough to participate on what happens on the other side. And I like to say we always come out the other side. Sometimes it takes longer or shorter, certainly, but we always come out of the other side. So that's the optimist. Maybe that's the ostrich in the sand thing, but we do always come out the other side. But you got to be here. You got to be solvent to be able to do that. So, don't do anything risky or that you'll regret tomorrow.
I love that. This is not the time to be a hero. We interviewed Janine Lee Chong at Waratah. I know you know her, and she basically said the same thing. She said there's no real reason to rush out and buy the dips. What investors have just been so rewarded. Buy the dips, because there's so much uncertainty. On the other side of this, when there's clarity and the goalposts don't keep changing, there will absolutely be things to invest in, but you have to know what the rules are. And the problem right now is you don't know what the rules are.
That's exactly right. And there are no rules in terms of the Trump administration, for example, because their rule book is based on a view that the president has had for 30 or 40 years that tariffs are a good thing. Not really based on any sound economic reality, but he believes that. And for some reason, not even for some reason, his spokespeople are supporting him. Even the smartest guy in the room, who should be Scott Bessent, is supporting him. And I just don't even get that. But so until we know the lay of the land and how much prices are going to go up, or how much further stock prices are going to go down, or what's going to happen in Canada as we retaliate, he hasn't come to us yet in terms of retaliation, but maybe he does. So we don't know about that for Canada. We'd have put reciprocal tariffs on. There seem to be more, when it comes to autos, for example, I mean, it's not a big deal because most of our trade in autos and auto parts is USMCA compliant. So it's sort of like, it's a statement, but it's not a real big impediment on the auto side. So we don't know what the lay of the land is. I wish I could say, yep, bum, 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 stocks are dirt cheap. The Fed's coming, the Bank of Canada's coming. No one knows that, but I do know things blow up. Everybody gets excited, everybody panics, and then we come back to some kind of level where sane heads prevail. And those sane heads may not be in Washington, they may be everywhere else in the world.
So you're saying that with the benefit of experience, whether you were in the newsroom or before that, when you worked in finance and on the trading desk. And I'm curious, does this moment seem like it has similar parallels? Like, what is similar to this moment and 2008? What's totally different?
So I think the financial system is in better shape, and we've had some major upsets. 2008, 2009, which was financial engineering, or you could go back to the 90s where derivatives and emerging market upsets blew equity markets up. COVID, which was a blast out of nowhere. Every time is different. Every time is different. And I don't know all of the differences this time. Does it feel like 08, 09? No, I don't think so. It feels more like COVID, a shot out of the blue that nobody expected. The Fed did come to the rescue, but that was a little bit different because everything froze up. Things are freezing a little bit, but I feel it's a little bit more like COVID than 2008, 2009.
I think that's good perspective. I think the way out is super clear, right? The tariffs, if you want to be optimistic, and I do too, is that they're so high, they're so egregious that like eventually the only way out of this is like the tariffs come out, they get lowered, deals happen, and then the market can feel comfortable again, right?
So
go ahead.
Scott Bessent has said, we know the ceiling, and where's the floor? So a lot of people are talking about 10% being the floor. And, the art of the deal and negotiations and all this kind of stuff. So you may see those tariffs all over the world come down. China's a little bit different. I think China is a little different. They're playing hardball for sure. They have a couple of sticks. Taiwan is a stick. You don't know what they may do aggressively. Their holdings of of U.S. Treasuries is a bit of a stick. So that's where the art of the deal may fall off the rails. So that's kind of, everybody's watching China, no doubt about it. Will they blink? Will Trump blink? Will Xi and Trump meet this weekend or next weekend or tomorrow? That's where I want to see some blinking happen.
So I saw this clip of Kevin O'Leary, Canadian, but I think he's gone. full alignment with the U.S. president. I think he was on CNN. He's saying it should be 400% tariffs. What China has gotten away with in terms of, IP, and then ultimately, sucking that manufacturing out of the U.S. to China and then selling those goods back to the U.S. It's the rule of law, the difficulty in doing business there, the fact that you can't go into China in the same way that you can go into the U.S. and do business, which I think, regardless of what you think of Kevin O'Leary, I think a lot of that is valid. You might argue that, is this the right way to go after it? But this is a thorn in the side for many who have tried to do business in China.
So that's absolutely fair. There's also these memes going around of Americans sitting in sweatshops screwing screws into iPhones. That is not going to happen. America's been a value-added economy. The U.S. has a $350 billion surplus on services around the world. That's where they excel. They excel in technology. They excel in the value add. They don't excel because they're making T-shirts in the Carolinas. And as another aside, the size of manufacturing in the U.S. has actually doubled in dollar terms, has doubled over the course of the past 10 or 15 years. But it's smaller relative to the entire economy because they're doing all these other things so well. So sure, China's not guilty in terms of what they've done, but America's had an insatiable demand for cheap goods, number one. Number two is that, penalize China, but don't penalize Vietnam, don't penalize Lesotho, don't penalize Botswana or Australia, that in fact America has a trade surplus with Australia. So on the bandwagon, he might be right on China, all kinds of reasons, including everybody wanting access to their cheap labor. And now it's coming back to haunt them. But that stuff's not coming back to America. That stuff, there's nobody who wants to, be in a sweatshop sewing. Those memes are pretty funny, actually, if you can take a look at them.
They are good. Yeah,
underwear.
It's sewing underwear, sewing bras together. That hasn't felt like the American dream for a while. But again, if we're going back in time, like maybe it is for the 1980s.
The unemployment rate's, close to 4%. People have jobs in the U.S. Do you want to pay $100 or $200? Maybe you do. I don't know, for a pair of underwear. No. So I'm an optimist, but I usually am. And all of those things are lining up, whether it's the VIX, whether it's the percentage of stocks above the 50-day or the 200-day or sentiment. All of those things are at a level where, if nothing else, you get a pretty good bounce.
All right. You were pounding the table there, literally pounding the table. Okay, Francis, we got to leave it there, but let's leave it on that optimistic note. And I'm good anytime that we get to speak. Thanks so much for joining me.
You're welcome. And thank you for giving me the opportunity.
Coming up next, we've got Darcy Morris of Ewing Morris. He's very interesting. He's an activist investor. We talk a little bit macro, actually. If you're an activist investor trying to get stock prices to go higher, how does that work when the whole tape is being thrown out? He's going to share some more stories and talk about some ideas that he's currently working on. That's coming up next. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Darcy Morris of Ewing Morris, thanks so much for joining me.
Thanks for having me.
There's so much happening.
I want to say, first of all, I was talking to Andy Willis this morning. He says hello and says he is incredibly proud of the job you're doing.
That's so kind.
And my sister, Deirdre, I spoke to this morning as well, and she said, you're killing it. So keep up the good work, and thank you for having me.
I appreciate it. There's that saying, 6 degrees of separation. We are 1 degree of separation 6 times over. So Andy Willis at the Globe, who you and I know. And of course, you're basically famous by association because your sister, Deirdre Morris, is like a rock star CNBC anchor.
That's true. And I'm an entrepreneur, so at heart, so I really appreciate what you've done.
Well, let's start there because you started this fund. And, it's small caps. You've got this activist bent. But, I'm a news junkie, so I can't help but ask you, the news right now is insane. We're in a full-blown sort of crisis. We've seen a huge plunge, particularly in U.S. stocks, but Canadian stocks are not immune to that. So you want to be an entrepreneur, you want to invest in special situations, but how do you think about the macro picture?
Yeah, for us, a time like this is we view it as opportunity. And when things get overdone, either to the top or to the bottom, that's really sort of a target-rich environment. So in the current environment, you have everything sort of correlating to one and selling off. And again, we know just on common sense that everything can't be the same. So where's the opportunity? And so for us, it's an exciting time to be an investor. It can be a challenging time to manage clients. So when people panic or want to do, rash decisions in this time, we have a job to do on the client side, and then on the investing side, we start sharpen our pencils, and everyone's excited to come in.
Are people panicked on the client side? Like in my lifetime, in my young career, youngish, I guess not so young anymore, but I've lived through 3 once-in-a-lifetime events, right? Mm-hmm. I lived through the financial crisis and the pandemic, and now this. People say this is on that level of what's going on. And with the fullness of time, that things do come back eventually. Are you finding that people are calm, or is there true panic out there?
Well, it's a mixed bag. It's a mixed bag. It can be, it's emotion, right? And money's a deeply personal thing. And so everyone reacts in their own way. I mean, for us, I clearly remember in the heart of the financial crisis in 08, 09, Jamie Dimon, the CEO of JP Morgan, was in the press, and he told this story how his daughter came home from school and said, Daddy, what's a financial crisis? And he looked at her and he said, oh, it's just something that happens every 5 to 7 years. So there's an element of that. And I think, behaviorally, strap your seatbelt on, don't make any rash decisions, but have a game plan and stick to it.
I haven't been asked yet by my kids on what tariffs are. Have you?
Right. A little bit. Yeah, a little bit. And I tried to explain it. It's going to make the cost of things more expensive.
That's exactly it. And everybody's got to figure out what that means for their business and what that means for their life. So let's marry that to your style of investing, which is activist engagement. You say it creates opportunity, but when everything is getting thrown out, can you really, as an activist, even do anything? You can have all, the best strategic levers to pull, but if everything is getting sold out, it's not going to be super effective.
Well, I think it depends on your time horizon. And so the way we invest, we don't consider ourselves traders. We really consider ourselves business analysts. And so we own a limited number of companies that we do deep dive due diligence. We look for managers that we know and trust that can operate the business in what we think is the right way. And so from that perspective, we view it as time arbitrage. So if most people are taking a really short time horizon, whether it's a day or a month or a few months or even 1 year, we can have an advantage by looking out past that point, 1 year, 2 year, 3 year, 5 year. Some businesses we've owned for a decade. And so in that sense, if you love the business, it's on sale. You just don't know exactly when it's going to come back to the right price.
So When now you've built up a reputation. I think people know when Ewing Morris has taken a stake and is calling you, it's for a reason, not just to say, hey, good job. Keep doing what you're doing.
No, we do that too.
You do that?
Of course we do that.
What's it like when you show up on the scene? Are people happy to hear from you?
Yeah, I mean, I think mostly they're happy to hear from us. I think the best investments you can have are when you're aligned with CEO, with management, sort of economically. So we look for managers that have a material stake in their own business and their own success, and that we have a shared vision of how to execute that game plan. So that's sort of like Mark Leonard at Constellation Software. Obviously, Buffett's a great example where it's give them your money and get out of the way, right? Those are the best investments. When it comes to activism, we're looking for situations where, I call it three-legged stools, right? Where there's something good fundamentally about the business. It's just missing one peg. And so, our approach is to analyze a business as if we would own that entire business with the existing management team in place at the existing price that you can buy it in the market. And when we meet with management teams, we already have a vision of what that is. And so it's sort of like a game of go fish, right? What is the next strategic business line or geography or what's the next strategy? And if it matches, then you sort of have a great starting point for an investment. And if there's something that doesn't match, then that might be an opportunity to engage with either management and the board, express our view, and get deeper involved with the company to help execute that view. So activism is effectively being our own catalyst for change.
The criticism is that activists come in and they say, do all these things that might provide a short-term boost for the stock, but are long-term bad for the business.
Well, I think that can be true in some cases. I think, maybe examples of putting too much leverage on a business that puts the whole company at risk.
You don't do that typically?
We don't do that. No, we don't do that. We're really looking for mismatches between the underlying value of a business and where it trades in the market, and then trying to understand why it trades at that discount, and then what levers can be pulled to close that gap.
And let's talk about the markets that you find those opportunities. I think you invest across North America, so you've got U.S. and Canadian stocks, right? But let's spend a beat on the Canadian market, because in some ways, a lot of these small and mid caps, they get kind of orphaned, and that can create dislocations. And do you think, do you see a lot of that? I guess is my first question. And is has activism helped you to breach that, or at least shed some light on those stories?
No, I think that's exactly right. When I started in the business, this was sort of electronic trading was just getting started. ETFs weren't as popular as they are today. And so you had a much more efficient small and mid cap market. And fast forward to today, electronic trading has kind of hollowed out the trading floors on Bay Street, which means there's not enough capital to put research on small and mid cap stocks. And so there's just not enough eyes on that. Plus the rise of ETFs are pushing capital into sort of larger cap names, right? And so to your point, the small mid cap space is orphaned, it's been hollowed out. And so if we were buying a stock, when I started in my career, let's say a 50% discount to what we thought was its intrinsic value, at that time, you could just sort of rely on natural capitalist forces through supply and demand to push it back towards fair value. Now you don't see that because there's just not enough trading volume. There's not enough people watching. So that's the opportunity where our evolution has said, well, let's just not stand back and wait for the market to correct. Let's get involved and let's see how we can unlock the value ourselves.
Activism is not really a new style of investing. It's been around for a long time. I think one of the most shocking forms of activism, particularly in Canada, was when Bill Ackman rode in and basically cleaned house at CP Rail at a level of CEOs in Canada that were viewed as very blue blood, not necessarily cream of the crop because the stock had been languishing. But I think it was a shock to corporate Canada. You were investing money at that time. Was that a big moment for the industry and your style of investing?
Absolutely. I mean, that was an eye-opening moment for me. And I think if you step back, like, again, hate the sin, not the sinner, but directorships have been a great place for retired professionals. Maybe it's retired accountants or Bay Street lawyers or investment bankers to really pad their retirement. And not all of them, but that's just, again, the incentive structure is such. And so you have corporations, public companies that are managed by management teams and board of directors that may have a fiduciary duty by law, but they don't have an incentive in terms of ownership. And so oftentimes when we find a company, we'll come in and we'll be the largest owner. And oftentimes we'll be the largest owner of the management team and the board combined, right? And so our view is we can bring a strong ownership perspective, because oftentimes it's the top 5 holders are ETFs or large mutual funds, where in many ways they're sort of absentee. And the Bill Ackman example was a great example of that, where I think this was a great Canadian business, been around for a really long time, that had seen complacency creep in, that had been reflected in its stock price. And he came in, became the largest owner, brought in a great operator in Hunter Harrison, and turned the company around. And a lot of people in Canadian, the business society didn't like getting their feathers ruffled, but ultimately it created a lot of value.
Did you notice a change in like kind of attitudes and corporate attitudes, like in the before Ackman and post Ackman when you were doing these campaigns?
A little bit. I think, again, for us, we're always looking at things like incentives and alignment. And, I think part of the issue is Canada is really small. And we're really polite, generally speaking. And so you might have a situation where there's an asset management firm in Canada where they see something with the business they're invested in that should be corrected. But then they go and look at the board of directors list and they notice that they have a bunch of clients on that board of directors. And so the tone from the top is, you know what, guys, sort of either sell the stock and move on, but we're not gonna ruffle any feathers here.
I was going to ask you about that, because activism is not for the faint of heart. And you're right, it's a really small community. And I imagine even for you on activist campaigns, maybe sometimes you're on the same side as a proxy advisor, and then sometimes on the very next campaign, you're on the other side. So you kind of have to maintain a relationship either way. Like, is this just who you are as a person? Do you not mind being adversarial and like walking into a boardroom and knowing nobody really wants you there?
Look, we don't want to be in that situation.
But you've been in that situation.
Yeah, I mean, it's for love of the game, right? And you see great competitors in sports that can compete against each other and then sort of hug and shake hands at the end of the game. I think that's our view. And the end goal is to unlock value for our clients, for all shareholders. And so we're really trying to be constructive. We really have to have conviction in our view. And if we have conviction in our view, then that makes it easier to sort of stand behind it. But we've had, I think, 15 or 16 public company board seats, the principals at Ewing Morris. I think we've been in the paper once inadvertently. And so it's really about working behind the scenes, win through the logic of our argument, through persuading management directors that this is what we believe is in the best interest of all, and hopefully finding that match.
We are going to talk about some of those campaigns in Pro Picks. But before we do, I'm just like a sucker for some of these stories. You must have just a war story, where maybe it wasn't going well. It became adversarial before you were able to shake hands and walk away at the end of the game.
Sure. Well, there was a company called ZCL Composites that I had come across early in my career. And this company was headquartered out of Edmonton, Alberta. What they did was they manufactured fiberglass tanks that stored gasoline underground at gas stations. That was their core business. And it was a wonderful business because the tanks only cost about $40,000, where if you're going to build a new gas station or retrofit a new gas station, it would cost millions of dollars. So this was a critical component that was just a fraction of the overall cost. And it was necessary, right? And so fiberglass was replacing steel as well because the warranty would last a lot longer. And they had an oligopoly. And there's really only two major players. And we knew that because they had tried to acquire their competitor in the US. It was shut down for antitrust reasons. And so that was their core business. And then they had an ancillary business, which was making these fiberglass tanks to store petrochemical byproduct above ground in the oil patch. And that business was losing money. And the company had about 18% profit margins. It had net cash of about 60 million. And we were really interested in this business. And our view was that the company should not do any more acquisitions because historically it hadn't worked. And the main one they should do was shut down for antitrust. That the main strategy for a business when it's an oligopoly is pricing, right? And so again, they had a lot of room to increase pricing, which would be dropped straight to the bottom line. And that they should return the cash to shareholders. And so we became a large shareholder in the business.
What year was this?
This is going back maybe 2015.
Okay.
But just to give you context, so we had a meeting with the CEO. We articulated what I just said of how we would run the business if we owned 100% of it. At the end of the meeting, the CEO said, you know what, guys? It's funny you say that because I have a working file on my desk for each of those initiatives. So the meeting ended. John Ewing and I went outside and he said, that was a strange meeting because the CEO knows what to do, but he's not executing. And so that was at a conference. And so at the end of the day, there was the cocktail hour of the conference. John Ewing went home and I stayed. And I saw the CEO at the bar. And I saddled up to him at the bar. And I said, you know, it seems like you know what to do to unlock value, but it doesn't seem like you're doing it. Why is that? And he looked at me and he said, because my board is weak. I don't have support from my board. And this is one of the first times that we became an activist investor. And I walked out of that bar immediately. I called John. We looked up the shareholder list. There was no large shareholders. We became one of the largest shareholders. And we sent a letter in advocating for those views. And it became contested. So the entire board was based in Edmonton. They're all members of the same country club. Half of them had a place in Palm Springs in the same community. And so I was younger, less gray hair back then. For, a relatively young hedge fund manager from Toronto to come into that boardroom, ultimately I joined the board, was pretty adversarial. And so that was an example of just, again, almost not letting the board meeting end until the points were articulated.
And then what happened?
So ultimately what happened was we divested the money-losing business. So we call that cutting the weeds or cutting the flowers and watering the weeds. So we divested the money-losing business, which shone a spotlight on how great the underlying business was. The stock went up. We returned the cash to shareholders in the form of a special dividend. I think we returned about $3 per share in cash. And then we sold the business. So
to Shawcor / Matter?
Correct.
Yeah, okay.
Yeah, correct. And so that was an example where I think our cost was around $6. We sold the stock at $10 and we got $3 along the way in dividends. And the end of that story is that in the Shawcor paid $300 million for that business. And at one point, post-COVID, Shawcor in its entirety was selling for less than, or for around $100 million.
So, yeah, that's a good point. It was sold in 2019.
Yeah.
And you bought Shawcor after. So then you got some upside there because you knew the value of at least one of their business was worth a lot more.
That's right. I'd say that's a benefit for being a small mid-cap investor in Canada because it's not so big. You have this institutional or accumulated knowledge on these businesses that you can follow these stories for a long time.
All right. This is I want to hear more about these stocks, so let's get into them in ProPicks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first one is Latham Group. The ticker is SWIM. So on the NASDAQ. So what does it do?
So Latham is the largest manufacturer of fiberglass pools in North America. And this was an example of a COVID winner. So it was private equity owned, and it IPO'd in 2021 on the back of sort of the COVID turn your backyard into your cottage. Not many people were traveling. Pool starts were really high. So it IPO'd at about $16. It went north of 30. And then when rates started to move in 2022, the stock went all the way down to sort of low single digits. And that's where we bought in. And so we think this is a wonderful business. Fiberglass pools are a substitute for concrete, and they cost a fraction of the price. Takes 2 to 3 weeks to put a concrete pool in your backyard. Takes 1 day with fiberglass. The repair and maintenance is a fraction of the cost. So think about concrete pools, sort of, they crack over time. And historically, the aesthetic was what was holding back fiberglass from really taking a lot of share. Now, fiberglass, you can hardly tell the difference. So it's an interesting setup where pool starts have not come back from that COVID peak, but they are taking share rapidly from concrete pools within their market segment. It's a situation where we love management. We've been to see a number of their sites. No, we like management a lot.
Who do you not like? Is there a board? Is there a board situation?
There's a situation that we're involved in right now, Parkland, where it's a contested proxy for.
Oh, right, and we're going to talk about that because that's one of your picks. I just spent a beat though on Latham. So it's a smaller cap; it's $600 million. And when I think about like pools in America, there's also Pool Corp, which is larger. So I imagine you also look at peers in the space.
Yeah.
So like, how does Latham stack up? Is Pool, which has also been under pressure, kind of a guidepost of where the stock should be?
Yeah, they're affiliated. They do different things, right? So Latham has about 50% market share in fiberglass pool manufacturing. So they're tied. You can think about it as sort of a auto part OEM and an auto parts supplier, or an auto OEM and auto parts supplier.
Okay, so what kind of upside do you think you can look? What's the fair value of SWIM?
I think the fair value of SWIM is at least twice where it is today. I don't know how long it takes to get there, but again, this is a perfect private equity type business. It's been private equity for most of its career. It may be bought by private equity again, but this is one of these businesses that we would be happy owning for 3, 5, 10 years.
It doesn't need to be bought out.
It doesn't need to be bought out, no.
Okay, let's go.
And maybe if it stays cheap enough for long enough, yeah.
Maybe it does. Okay, your second one, I remember reporting on this, so let's spend some time on First Capital REIT. This is also part of your strategy we didn't get into. You have a special interest in real estate. And we've had a number of guests come on and say the gap between, real estate in public markets versus private markets is huge. But you got in First Capital kind of like a long time ago, and that was contested. But now you're everybody's friends at First Capital.
Yeah.
Okay, can we start at the beginning? What first brought you to First Capital?
Well, so our view on real estate in the public markets is that it's one of the only areas where sort of the market for real estate is more inefficient in the public markets than the private markets. And generally it's the opposite, right? Because private markets are opaque and you have to negotiate deals, where in the public markets you can just buy stocks and talk about efficient market theory, what have you. Whereas in real estate, we think that might be the opposite. And part of the reason is because if you are excellent at real estate, you're likely working, on the ground for a Blackstone or a Brookfield or a KingSett here in Canada, where you're evaluating the dirt, you're doing deals. And if you're top of your class at Harvard Business School and you want to get into real estate, you're not going to be the REIT analyst at RBC, not to take, or one of the banks, not to take away from that person, but generally speaking. And so we've historically found the REIT space to be a great source of opportunity. First Capital, that was an area where we had success in grocery anchored retail. A New York Stock Exchange listed company called Cedar. That was an activist situation where I was on the board. We're really comfortable with grocery anchored retail. And it can get lumped in with retail of all sorts. So there's fast fashion, there's quick service restaurant retail, there's shopping malls, etc. Grocery anchor we just thought was stable, because even if online commerce was going to disrupt grocery shopping, there'd still probably be last mile distribution or what have you. And so we're really comfortable with that asset class. First Capital was what we thought, and is today, the best collection of real estate assets in the country. That was, it was founded by a guy named Darcy, who we're really close with, who we work closely with. And his view was sort of covered land plays in high density, urban, high income communities across the country. And he executed on that. And when we got involved, the stock was trading at about a 35% discount to its net asset value. Our work was to firm up what the right net asset value was. And that's been generally the description, where the private market is saying one thing, public market saying nothing or another. And the truth is probably somewhere in the middle. Specifically with First Capital, we had a view, and we do have a view, that there's probably too many retail REITs in Canada. There's double the amount of retail REITs per capita in Canada than there is in the US. And when you think about synergies, so having management teams that manage the assets, sort of leasing synergies, tenant synergies, we think there's real value to be had by combining these businesses. And First Capital is the natural company to be acquired, because there's no controlling family behind it like there is in a lot of other REITs in Canada. There's no big institutional owner like a pension that owns 10+% of the company. So really fractured ownership, really attractive assets, and a lot of reasons why it would make sense combined with another REIT.
So you're pushing for a transaction, for First Capital to do a transaction.
We think that they could do a transaction that would unlock value.
Now, that's where it stands today. Because I remember, I think I was interviewing on this story when I worked at BNN. And so there were, this got pretty ugly, right? Didn't it go to the OSC as well? Can you, and Dory Siegel, who's no longer with the company, was kind of who you were working with to talk about unlocking value. How did it go from so acrimonious to where it is now? How did you break through and find resolution?
Well, ultimately, you try to find alignment, right? And when there's an issue, it's because there's misalignment. And so sometimes you see management teams or boards that are entrenched because they like the status, they like the income rather than sort of the equity ownership. And oftentimes the best way to come together is to sort of maybe rejig the incentive structure through compensation or what have you. In the case of First Capital, we settled with them. There are 2 new board members that went on. And
Ira Gluskin
and
is
Richard
one of them.
Nesbitt, yeah.
And Richard Nesbitt. And of course, everybody on Bay Street knows Ira Gluskin, but he has got particular chops in real estate.
Absolutely. And he's an interesting character in that he can kind of straddle the world of real estate and asset management. But I will say First Capital has been the best performing REIT in its sector since we made that investment, and management team's done a lot of the right things.
So it's rolled over a little bit. It's down 18% from the high in the summer. Again, it's one of those maybe activist situations, but you just can't fight the macro.
can't fight the macro. And that's what I mean why these are opportunities to increase your investments if the facts haven't changed and you like the business.
Okay, so you see an opportunity there.
Absolutely.
Let's talk Parkland, which is an ongoing situation. So you tell me how much you can talk about it or not. But people call this kind of like a baby Couche-Tard, right? It operates those gas stations. And there have been those, over the course of a couple of years, even though the stock has done well, until it stopped doing well. But even though the stock had done well, people saying there's more. You can do more to unlock value. Now they are in contention with their largest shareholder, Simpson Oil. It's getting even more acrimonious. The stock is trading at the lowest level since 2023. So it has really pulled back. But, honestly, so is the whole market. So where are you in this? Are you alongside Simpson Oil? Do you align with the dissident shareholder that there's a lot that could be done here?
Yeah, we would agree with that. We've been an investor in Parkland for a long time, and we think it's a great business with great assets. But there's been a lot of corporate governance missteps that have led to value destruction.
Like what?
Well, I think when you have a 20% shareholder, it's like having a customer that's 20%. I think you have to get along with them. And that 20% shareholder has been alienated, they've been accused of trying to, seek control of the board, which I don't believe is true. Yeah. And so what we'd like to see is a fair process, and not to see entrenchment, but to see a board work collaboratively with their shareholders, not just the Simpsons, but other shareholders like Ewing Morris.
So Simpson Oil has nominated 9 board members. They want the CEO out. And if I recall, do they also think this company should be sold or explore selling itself?
They should explore strategic direction.
Who do you think the buyer is?
Well, I think there could be a number of different buyers, but I think the first thing is to have a proper strategic process run and a proper special committee struck.
You mentioned you're satisfied with the management of Latham. Let's talk about the management at Parkland. And is this a management problem? Is this a board problem? Is it both?
Well, I think it's become evident that it's both. And I think there's been too much focus by the board and by the management team on retaining control or sort of entrenchment of their seats. And I think that served as a distraction. When you look at the near-term track record of acquisitions, they have not been successful. And so that distraction, I think, has led to the business underperforming. And that's the goal of the activist investors.
A strategic review in this environment, do you think people are up for that? Would buyers even emerge, right? Yes, the stock is down. You might get it for cheap, but everybody's got problems now. Is that a fruitful use of people's time?
It's an excellent point. Things are happening so fast. So a few months ago might have been a good point, a good time. They've announced a strategic review, and that's before the upcoming election for the new board of directors. So I think even that as an example of why wouldn't they wait to see how the new board is constituted to run a proper process is just another example of management.
At $40, when the stock was, doing well, or even $45, activists were still on this company saying you could do better. Now it's at $30. What is your fair value?
Well, I have to be careful on this one, but I would think it's well north of 40. Well
north of 40. Can you elaborate a little bit more on who you think the buyers are, even if you don't name names? Do you think it's another operator, or do you think this is a private equity type investment?
It would be a big private equity investment, but it's possible.
All right. I won't push you too much on it. Thank you very much, Darcy. I've had a great time chatting with you.
Thank you, Amber.
Thank you so much, Darcy Morris of Ewing Morris, for joining us. We'll be right back. This is the ETF Minute on In the Money with Amber Kanwar. Today we're talking about the CI Global Infrastructure ETF, ticker CINF. To help us do that, we've got Kevin McSweeney. He's portfolio manager and lead for Canadian equities and global infrastructure at CI Financial. Kevin, thanks so much for joining me.
Thank you, Amber. Nice to be here.
So let's talk about this ETF, the characteristics. Why does somebody need an infrastructure ETF in their portfolio? Is it defense? Is it offense? Tell me.
It's defense without compromising on returns, to be honest. It's been a solid returner, but it is defensive because you're talking about the fund is populated by companies, pipeline companies, utilities, telecommunications infrastructure, and transportation that have very strong cash flows, very strong moats, and are not exposed to the ups and downs or volatility of consumer spending, less exposed to global economic fluctuation.
I wonder, though, is this sector going to be hurt by reduced government spending? I mean, they certainly benefited from this massive stimulus, particularly out of the US. And now, with Doge, they're looking to reduce spending.
We do have a little bit less exposure to the engineering and construction companies or aggregates that are in there. And so when you think if a government was going to stimulate with a road, by building a road, that would actually take away from our toll road exposures. And so the pullback in government spending, first, removes a competitor, but second, to the extent that that might create economic weakness, we do tend to have some sectors in here, utilities and telecommunications infra in particular, that benefit extremely strongly when interest rates are headed down without their valuation goes up without their cash flows coming down.
So let's talk about how the fund is structured to capitalize on some of those trends.
Sure thing. We refer to the sectors within the fund as PUT. Pipelines, utilities, telecommunications infrastructure, as well as transportation. So pipelines are about 20% right now. They've had a good trade with the whole drill, baby drill, or exports, and a good energy tape. That's about 20% of the fund. Utilities are about 45%, extremely defensive, benefiting from electrification, benefiting from increased power demand. Whether data centers are as big as people say, we don't know, but utilities will be around. Another 12% are in telecommunications infra, such as cell phone towers and data centers. As well, about a quarter is in industrial infrastructure, transportation, ports, toll roads, airports.
So, and it's actively managed.
Very actively managed, high active share. And we certainly make our views known on both the sector and the individual security prices we're dealing with.
Well, let's talk about some of those individual securities. Can you give us some examples of stocks that exemplify the thesis you're talking about?
Sure. I'll do one global and one Canadian, perhaps. So one of the ones we love overseas is it's called GetLink. They operate the Eurotunnel that goes between London and Paris. That is a very monopolistic, very high barriers to entry to build something under the channel. And they have that concession for an extremely long time, just getting a flat fee for every passenger, not worried about, whether they have to stimulate more passengers with extra tickets or things like that. They have, and truck shuttles as well. We also like, closer to home, we like TransAlta. That's an Albertan utility that I think is world-class in terms of its exposures, in terms of its growth, and in particular in terms of its valuation. It's come off a little bit recently just because it had been a hedge fund favorite on data center trades, trading an extremely good valuation right now, and we're happy to hold a good size position in it.
Kevin, thanks so much for joining me.
Pleasure. Thanks, Amber.
That's Kevin McSweeney joining us from CI Financial. To learn more, go to www.cifinancial.com. Thanks, everyone, for tuning in to this very special episode of In the Money with Amber Kanwar. Don't miss our next episode. We've got James DeVolis on the show. He's Vice President and Portfolio Manager at Horizon Kinetics. He's been positioning for this massive global transformation in the markets. And quite frankly, these days, it's really paying off. If you've got questions, you can email us at questions@inthemoneypod.com or hit us up anywhere on social media @inthemoneypod. We'll catch you on the next episode.